Good evening, everyone. Just a quick background to me. I spent 25 years in the city managing UK equity funds for pension schemes for sort of local authorities, sort of final salary pension schemes or big corporates. When I look back at it, I thoroughly enjoyed it, but it was pretty boring stuff actually, because the target each year was all share plus 1%, or maybe 1.5%. Which for a big fund, over a number of years, if you achieve that, that's quite a lot of money. But I did spend a lot of time in committee meetings deciding whether we should be 1% underweight in Shell or 1% overweight. So last 5 years, 6 years, I've been a full-time private investor, which is much more fun because basically I have one simple aim, and that's to make money. Obviously not to lose money and try and keep the volatility down, but to make money so that I can enjoy a really nice retirement one day. So this evening I'm going to cover, two topics. The first was sort of investor shows. I've been to 2 in the last 2 Saturdays. Some people might say get a life. The first was was the Master Investor Show in Islington a week last Saturday, and then Saturday just gone, UK Investor Show. In some ways, these shows are very disappointing because the companies they get along to exhibit, there's not many of them that are really worth talking to, in my opinion. I mean, they're all sort of blue sky stocks, they're resource stocks, or maybe health stocks or biotech stocks, but a long way from making money and a bit speculative, so not really for me. But there's some good speakers though at these things, and so Master Investor, it was Jim Mellon who I was interested in hearing, so I really only went along for that. I saw he dropped down, I think, to 135th in the rich list with 800 odd million. So he must have done something right at some stage. But I think he's pretty good at sort of big themes and looking ahead, over the next year as to things that he thinks might happen, quite thought-provoking. So on to his speech. Well, actually, just back to him. I mean, it was after reading one of his books in 2012, Cracking the Code, Understand Profit, Understand and Profit from the Biotech Revolution. That's what got me into buying the Biotech Growth Trust, which went up about 5-fold over 4 years. And it's come back in the last year a bit, but it's still up about 3 times on my purchase price. In that case, I chose the Biotech Growth Trust because I didn't have the expertise to buy individual stocks, in that area. So therefore left it to the professionals. And quite often I'll do that when I want to catch a theme, but don't have the confidence or the knowledge to pick individual stocks. So he started off on a week last Saturday saying that he thought that we were seeing the beginnings of the end of deflation. And he then went into all the sort of normal stuff about too much QE. Now we've got sort of negative interest rates. That there's moronic people out there buying bonds at 100 to get back 95 in 20 years' time without including inflation in that. And I have to say I have some sort of sympathy in that. He's saying you're starting to see some obviously divergent moves. The US obviously have started to put up rates. And I guess he thinks that will continue. I mean, employment's pretty strong there. So they may have delayed things a bit, but that's what's going to happen. So he says change is coming, and I don't think he necessarily means hyperinflation, but even in the UK the average inflation has been, I think, 2.5% since 2008, and so it wouldn't need much of a pickup in inflation maybe to get some investors slightly worried about things. What other things did he come up? He wasn't keen on the minimum wage at all. The higher it goes, the more people will be substituted with machines, which I guess, there's a lot in the papers nowadays about robots and the like. And then taxes will go up because if you have unemployment, someone's got to pay for it. Moving on, what else? Brexit, and then I'll just get on to his conviction ideas. Brexit, I mean, quite clearly he was for leaving, but he didn't think either result would, either result was probably in the price now. So, given his thoughts on inflation, I guess it's not a surprise that one of the conviction ideas was gold. So gold, silver, platinum, saying 20 to 30% of your portfolio. Don't know if you agree with that. Short negative yielding bonds, and there's some ETFs you can buy to do that if that's what you want to do. Japan, still very keen on Japan, one of the cheapest markets. Thinks helicopter money will come there. He likes the Nikkei, likes big companies, and particularly he picked out Sony, Fanuc, which apparently is a robot company, Gilead, the big biotech company. It's on about 7 times earnings at the moment, stuffed full of cash. Thinks that it's more than discounting any concerns people have over drug pricing. China, the day of reckoning, he thinks is some way away. So he's saying, modestly buying maybe Fidelity China special sits. I was glad to hear he mentioned a stock I hold, which isn't to everyone's taste, Avation, the aircraft leasing company. Glencore looks cheap, seller of London real estate. India looks promising, likes that, but buying a setback. Oh, and then a company called Critical Elements, which basically is a lithium miner, thinks that will be a big growth area given electric cars. So that's all very well. So what have I done? After that meeting, I actually went away and thought about it, and I had some sympathy with the inflation story. And also, so I have bought some gold. I've put 5% of my portfolio into gold. Not into physical gold or a gold ETF. I'm not that keen on gold per se. It doesn't pay a dividend. There's no cash flow or anything like that. How do you value it? It's really just a confidence story. But what I have done is bought an ETF from ETF Securities. It's the DAX Global Gold Mining ETF. And it invests in, the big names are things like its biggest holdings, Newmont Mining, Barrick Gold, Goldcorp, Rand Gold, Newcrest. So again, I want an exposure to gold mining shares where you get the gearing from gold moving up, but didn't really want to pick my own stocks in that area and quite happy to leave it, buy it through an ETF. The charge on that fund is 0.65%, so the annual charge, annual fee. So quite low, quite a nice way of getting exposure. Fingers crossed. On Saturday, I went to the UK Investor Show. Nigel Ray was probably the star speaker at that, with a few pearls of wisdom, and I'll just read these out. He likes companies where management have decent shareholdings and pay themselves modestly, skin in the game. And then sort of on running a portfolio, get rid of the rubbish, run the winners, we all know that. But as we know, it's often difficult. Selling losers is difficult, but you have to do it, and the quicker the better. Yes, you were very decisive, you were telling me earlier on, getting out of a load of stocks, and it's about being decisive and just doing it. Selling winners are always tempting, but normally wrong. Don't think you are wiser than the share price. If it's going down, it normally is for a good reason. Don't worry about markets. Be confident about the businesses you hold. So I guess know the businesses. At UK Investor, I also attended the Gold Forum, and not surprisingly, the panel was bullish, which, having just bought my 5% exposure, I was found very comforting. But I guess Peter Hambro of, I can never pronounce it, Petropolovsk or whatever it's called, he was pretty good. He thinks that actually all commodities are now going to, recover, especially gold, but he was keen on copper, suggesting that the supply side is tightening quite a lot and that demand will pick up. And if we do have inflation, I mean, they're playing that theme again, commodity prices should benefit from that. So they were talking about a bull market in gold, normally 3 to 6 years, just at the start of a new one. I quite like the way the chap who writes in Money Week put it, Dominic Frisby. He just said with gold, you're either in a bear market or you're in a bull market. And he said, if you look at it now, we're back in a bull market. And I guess the breakout last Friday, I think most chartists might suggest we are. So I've brought a little bit of exposure to that. Another part of the show that was quite fun was the Dragon's Den. They had 4 or 5 companies presented for 1 minute each. And then a panel of the 3 organisers would basically vote on where they were going to put £1,000 in the stock today. And this exercise was repeated 5 times over the day, with different companies obviously. I only stayed for the first 3. Remember, I do have a life. But it was quite interesting. The first round they had Nostra Oil. This is what I was saying about resource stocks. They had Nostra Oil and Gas, Noricum Gold, Fox Marble, Eurasia Mining. And the winners there were Eurasia and Fox Marble. The second round, the winners were Extract Resources, but that was mainly because the CEO in his 1 minute basically said, if you put your 1,000 into my stock, if it's not trebled in the next 6 months, I'll give you your 1,000 back. But unfortunately, that wasn't open to all of us. So they won. And then the last round winners were, well, before I left, were Prometha and United Cocoa. Apparently there's a big shortage in cocoa and it's going to get worse. And that's a great commodity to be buying now, but there you go. So that's enough of investor shows. April. I managed to scrape, well, on Thursday night I was a bit nervous because I thought this was going to be the 4th month in a row where I'm behind the index, which is not going to look very clever. But Friday was a wonderful day, helped on by Crawshaw and Sprue Aegis bouncing up very strongly. And I finished the month up 1.3 against the FT All Share total return, which was up 1.1. But obviously I'm still behind since the beginning of the year, down 3.7%. Just on Crawshaw, everyone's favourite Northern Butcher. I'm not really, I mean, they had results last week, but then they've been doing the rounds of the institutions, and I think are still doing them early this week. I'm not surprised the share price has gone up, because I defy anyone who meets that management to resist buying some shares. I mean, it's difficult to value. I think you've got to really believe the story that they'll succeed in opening 200 odd stores over the next 6-7 years. But if they're going to that management team, I think under Noel Collett, should achieve that. But what was more pleasing about being ahead of the index in April, and I guess that shows the benefit of running a sort of diversified portfolio, was that, having avoided profit warnings, tiptoeing through the minefield for some time, I got hit by 2. The worst, well, there was one, was I do a weekend roundup, and I basically wrote, I can't see any any results next week for companies in the portfolio, in my portfolio. But I'll be at my desk at 7 o'clock every morning, ready for any surprises. And so Monday morning, I was there at my desk at 6:45, and Sprue Aegis came up, trading statement or something. Oh, I thought this must be good. This will be a good one. I read that, and I just, oh God. So that was the start of that. And obviously the share price plummeted. And then the following Monday, we had St Ives, which I held, or which I held. And I think I've read that there has been a big increase in the number of profit warnings. I think I saw over the year to the end of March, so the most since 2008, 312. In the first quarter there were 76, and it feels like April was pretty bad. It certainly was for me. So how did I react to these? I mean, my default action with profit warnings is generally to sell and move on. Get out. I always feel much better when I'm out of them. Don't have to worry about what to do anymore, and can then just move on to the next thing. But in these cases, I did something different. I was going to say, profit warnings rarely come in ones. I mean, Restaurant Group, a good case there. I guess the only surprise there was how quickly the second warning came after the first. But as I say, with the two, Sprue and St Ives, I reacted differently. With St Ives, I sold. I've made good money out of this stock over about 4 years since I first bought it. But what worried me here was the way they explained that everything was fine up till April, and then basically things had fallen off the cliff, and the last quarter of their year looked poor, and they were going to be materially behind expectations. But then looking into next year, they couldn't give any guidance there either, and so it just worried me, and it felt to me like a stock that there's a good chance that a few months down the road you might get another warning there. I got out of that at about 1:45, and I see today and I felt then I got, there's always that worry. You think, oh God, I'm going to look really stupid selling at this price, and maybe I will in a year's time. But as I said, I've moved on. But I did have a look today, just out of interest, and they're down at 108. Now with Sprue Aegis, I took a different view. I mean, the shares fell pretty quickly on the open. But I felt with this one that the problem they had hopefully would be a sort of one-off blip, and that's something they could recover from. But what I liked about the way they approached it was they were very clear in terms of the cost of sorting out the battery issue and how much they provided. I mean, obviously you thought, is that enough, and things like that. But they were very clear with the guidance they gave for this year's profits, both splitting it first half and second half. And so with that in mind, I thought, and they had a strong balance sheet. At the year end, there was 22 million of cash on the balance sheet. So with that in mind, I thought it would be worth at least waiting till the results the following week and see what they did with the dividend. And also, there'd be an opportunity, hopefully, to question the management. That opportunity came last Wednesday evening, and they reassured me enough at that meeting that they had reserved enough. They'd been very conservative with that problem. With the batteries, they were on top of the problem. They also reassured me that with their guidance for the first half of this year and the second half, that they've been conservative. Graham Whitworth, the executive chairman, sort of said, he did say, I think he understood that it's best to have one profit warning and get all the bad news out and follow it up with another two. And I think that's what they've done. He said, you know, there is only one profit warning, now we have to deliver, deliver, deliver. In terms of what they forecast, second half of the year profits of 3.8 million. Well, I think second half of last year they made 3.1 million. So, you know, it's quite a good bounce back after, you know, the first half of this year. I also like the fact that, you know, management have decent stakes in the business. They've got, you know, he I think's got just under 7% or around 7%, and the managing director around 5 or 6%. So with this one, I actually added to the holding. I added at 124 and 135. And nice to see, obviously on Friday it had the big move, and another small move today. So, as long as there's no more disappointments, I hope that'll recover. I mean, obviously, if there is, then I've judged it wrong. Then moving on, one last one. I mean, the most difficult decision for me in April was selling my holding in Next. You know, I think the management is second to none in terms of their approach to creating shareholder value. But I think I was a bit slow here. I wasn't decisive enough. I should have sort of just really looked at it earlier in the cold light of day. But it seems that they've, you know, I think they have got a bit of a problem. I think other online retailers have perhaps caught up in terms of next day delivery, free returns, all that side. Directory used to make a lot of money out of people buying on credit. Now people are paying with their own cards, basically taking their own credit. And he pointed out to these problems. Also, if you look at March retail figures, the high street really got hit for fashion, but online was up. So maybe there's more of a trend. Certainly, looking at my front hall, I've got a 17-year-old daughter, and it's like a parcel sorting office, things coming in and out on a daily basis. So that was a difficult one. There's a trading statement tomorrow. That may make me look really stupid. On the other hand, as I say, once you sell, I think move on, and hopefully, you know, pick some other good stocks. You have more winners than losers. That's it. I'll start measuring on.
Thank you for that, John. We've got a couple of minutes. If there's any quick observations, comments for John.
Vislink, you still there?
I am still in Vislink, yeah. But I'm in it, but I'm looking forward to getting out. That is one where, you know, last July, when they came out with that very generous scheme for themselves, you know, I wrote a letter to a non-exec director and things. Actually, I should have just sold them instead of thinking I might be able to get some change or anything. Should have just said, I don't like it, sell them, rather than writing a letter. Having said that, I think it got overdone. They're miles offside with their thing. I think they've probably got some quite good products. It's really just the management who certainly don't tick those rules of Nigel Ray's in terms of overpaying themselves.
There's an AGM coming up where you can go and give them some grief.
Yeah, yes.
Okay, thank you very much, John. Much appreciated, and we hope we'll get you back again sometime soon.
Thank you.